Welcome to lesson 1. Please pause the video and read carefully the disclaimer. Alright, I don't intend to make this video long because we have dedicated a session for Zoom meeting to explain the topics we discussed in all the lessons. Okay. Lesson 1 is market structure. We will look at market profiles, also look at breaking market structure. We will also look at shifting market structure. We will talk about our time frame matrix. We will look at market structure fractals. At the end of this presentation, you should be able to classify market movement into profile. You should also be able to anticipate and identify a change in trend or a change in market direction. You should know where and when to take a trade during a change in trend. The forex market can be classified into two profiles. The first profile is a ranging market, which also known as consolidation or an accumulation. It is the situation where you don't see a direct direction in the market. Then we have a trending market. This is where you can see a trend, right? So we are saying that a ranging market or a consolidation is a period of range bound activities after an extended price move, right? And that the major characteristic of a consolidation is that price creates a narrow trading range, right? And then we also see that price fails to create series of higher highs or lower lows, right? So the major characteristic is that there's a narrow trading range, and then 2, it fails to create series of higher highs or higher lows, lower lows. So we have an example here where there's a resistance at the top, right, and then a support, and we can see how price is trapped within this trading range, right? And then it finds difficult to close or break the resistance line or to break the support line, right? And then this kind of consolidation is looks like a rectangle, something like this, right? There could be other forms of consolidation that look like a triangle, something like this. Right, and so in here the characteristics are still the same. Price is failing to make series of higher high, right? It's also failing to make series of lower lows, right? And it is bound between this range, this trend lines. All right, so here we have a narrow trading range. Okay, so a trending market is a market that continues to close higher and higher, right, or lower and lower, right? So here we are saying that for a market to be considered to be trending, we want to see price close higher than the previous high, or we want to see price close lower than the previous low. There are two kinds of trending market. We have an upwards an uptrend or a bullish trend or a bullish market. Then we have a downwards trend, right? That is a downtrend and a bearish trend. So for an uptrend, we are seeing that an uptrend is a market that makes series of higher highs and higher lows. A market that makes series of higher highs and higher lows. So as you can see in this image, right, we have price starting from this low, create a high, pulls back, create a higher low. The reason this is called a higher low is that this low is higher than this particular low. It is above this low, right? And then goes up, breaks this high, create a new high called a higher high because it is higher than the previous high, then pulls back, and then you see it continues like this. So that is a normal behavior of an uptrend. An uptrending market will create series of higher highs and higher lows. A downtrending market is a market that makes lower lows and lower highs. So for a market to be considered in a downtrend, we want to see series of lower lows and lower highs. So this is GBP USD on 4-hour chart. We see that price makes a low, pulls back, creates a lower high, because this high creates a high which is higher than the previous high, right? Creates a lower high, then breaks the previous low and creates a new low. So this low is called lower low because it is lower than the previous low, right? Lower high and lower low. So this is a normal behavior of a downtrending market. This is supposed to be a downtrending market, right? So downtrending market makes a series of lower lows and lower highs. So we look at break in market structure, right? As we already saw in the previous image, GBP USD was creating series of lower lows and lower highs. Now we want to look at what a break in market structure is. So each time price creates a lower low and lower high, you have to mark the highs, right? If price comes back in a downtrend and closes above the previous lower high, okay, we call it a break in market structure. The implication of a break in market structure is that it tells the trader that the market is changing direction, right? So since the normal behavior of a downtrend day market is to make series of lower lows and lower highs, then we don't expect price to make what, a higher high in it. When it makes a higher high, then we have an abnormal behavior that should tell us that the market is changing direction. So as you can see here, right here, we could have marked this area, these highs, and wait for price to break them, close above it, and then we know that now the direction has changed. So if price failed to break this particular high, right, and created a new low, so now our attention will be drawn to this high and then this low, right? Breaks a new low and then closes above this high. Okay, so this is what we term as what, a break in market structure. A break in market structure, right? So we have a break in market structure here, right? Breaks the previous low and then breaks the previous high. This is called a break in market structure. So we are seeing that a break in market structure occurs when the market begins to shift direction and breaks previous higher high and higher low in an uptrending market, or a lower low and then lower high on a downtrend market. So you see that the lower low was broken here, right, and then price broke what, the lower high. So we look at an example. The first example was suggesting a change in a downtrend, from a downtrend to an uptrend. So we want to look at a change from an uptrend to a downtrend. So we have this, right, price going up, creating series of higher highs and higher lows. Now we realize that price makes these two lows, the previous higher high and then the higher low, right? And eventually price trades above the previous high, stop, which is a stop hand, right? Take liquidity and then drop below the previous low. When market breaks a higher low in an uptrend, then we have a break in market structure. This signifies that the market is about to change direction and that the trend is going to be down, right? So we look at the shift in market structure. We are seeing that shift in market structure is a retracement or a pullback that occurs after there has been a break in market structure, right? So here, this pullback, you see, after this market broke structure, we can expect market to pull back in here, right? And so this pullback is what we are terming as what, a breaking a shifting structure. So we have a market trending upward, right, and creating series of higher highs and higher lows. So anytime a higher high and a higher low is seen, right, is created, we mark those highs. We see price trade above the previous the higher high, the last higher high, and then again trades below the higher low, giving us what we call a break in market structure. Then market pulls back into that range, right, and then drops. Okay, so from 4 to 5 is what we are terming as what a shift in market structure, and then we don't expect a shift in market structure to go above the new high that was created during the stop hunt, right? So we don't expect it to go beyond 0.3. So we have a bearish scenario here. Same case, you have a shift in market structure, which is not, we do not expect to go beyond 3, right? All right. So now here we have our time frame matrix. So this is just was designed to help people or traders to pick trade, high probability trade. For instance, if you are seeing a break in market structure on a monthly chart, right, you should wait for a shift in market structure on the same monthly chart. So when the shift in market structure is occurring on a monthly chart, you go to the weekly chart or the daily chart or even the 4-hour chart to start looking for a trade, right? So your execution time frame is weekly or daily if you see a break in market structure or and a shift in market structure on the monthly chart, right? Same thing applies to the daily chart. You want to see a break in market structure on the daily chart, look for the shift in market structure on the same daily chart, right? Then you execute your trade on either the 4-hour or the 1-hour chart. Next, you can also be looking at a break in market structure on the 1-hour chart. Look for shift in market structure, wait for a shift in market structure on the same 1-hour chart. Change your time frame to 15 minutes to look for your a trade, or 5 minutes to look for a trade. What this means is that if you have a market trending upward on the monthly chart, and then we see a break in market structure, market trade below the previous higher low, this break in market structure that we've seen, you have to wait for a shift in market structure to occur on the monthly chart. Then while the shift in market structure is happening on the monthly chart, right, you should remember that this shift in market structure is a whole trend, it's a bigger trend on the weekly chart or on the daily chart or on the 4-hour chart. So you transpose to the lower time frame, and then because this shift is going to be something like this, right, you want to wait to see a break in that structure here, and then a shift, you get a good entry, and then you begin selling. All right, that is all the time frame matrix is about. All right. So fractal formation, market structure fractal, we are trying to combine everything that we have looked at, from the trending market to the breaking market structure, the shifting market structure, and then the time frame matrix, right? So we have a market trending downwards, right? This is a 4-hour chart, right? Trending downwards, creating series of lower lows and higher lower highs, right? Now we notice that here a lower low was formed, there was a pullback and price created a lower high, then there was a break in the lower low, price traded through the lower low, right, and came back to break structure by taking the previous lower high. And we said that in a downtrending market you don't want to see what a high taking, right? So since we saw this high taken, then it means that there has been a break in market structure. That does not mean you should start buying from here, right? So we wait for a shift in market structure, right, which is the pullback after a break in market structure. So this is a shift, right? So we have an SMS here. Now the beauty is of that is that we can incorporate our time frame matrix in it. This is a 4-hour chart. So on a 4-hour chart, right, this shift in market structure is a whole trend on a 50-minute chart and a whole trend on the 1-hour chart, right? So it means that we can shift to 1-hour chart and then look at this particular shift as a whole trend and still wait for a break in market structure, and then begin to trade in the direction of the new trend, right? So let's see. This is the parts, this part that we've boxed. Okay, this is it on the 1-hour chart. So we can see the series of lower lows, right, which is the entire shift we were talking about, SMS we were talking about, right? So we can see that price creates lower highs and lower lows. So this was the last low that was created. You can see how price traded here, right, and then created this particular high. So we have a new low, a new high. So this is the premise for measuring our breaking market structure. Now price traded inside it, right, and then went and broke this level, this previous high, which signifies a change of trend, right? So in here we could have taken our trade somewhere here, which is not the best, right? But when we advance, right, we are going to learn how we could have taken the trade from here, right? But this is better than taking the trade off the 4-hour chart, right? Okay, so again, this is the same chart on a 15 minutes time frame. We have series of lower lows and lower highs, right? This was the last low that we marked at the previous time. So we can see here there's a break of structure. Price trades below all the lows and then breaks one of the previous lower lows, lower high, sorry, right? It closes above it and then pulls back into this range. So this could have been an entry, because we know that the shift in market structure cannot go beyond the break in market structure. So we could have gotten this entry here, right, with a stop loss just below here, right? Now we could have been more conservative by waiting for price to break this high, right? So after market closes above that particular high, right, we can take a trade from here, because price traded into this candle, which we are going to talk about in later videos, right? So we could have gotten an entry here. We could have also gotten an entry here, because this is what price traded back into a discount level, right? So in here we could have had 1, 2, 3 entries, okay, giving us a better risk reward. Okay, thank you very much. This is the end of lesson 1. Our next lesson is going to be on price imbalances or inefficiency. Thank you.